Hello guys, what's up and welcome to my YouTube channel. This is Gleam. Thank you so much for keeping up with this channel. Thank you so much for liking my videos. Thank you for your love. Thank you for your support. You have really kept Gleam going this far. I'm so sorry that I took a long break. I've not posted in a while. So thank you guys for keeping up with this channel. So in our last video, we talked about liquidity of a business. We looked at trade receivables. How does the trade receivables, how does it have an impact on the liquidity of a business? So today we'll still be talking about the liquidity of a business, but now we're going to be looking at trade payables. How does the trade payables impact on the liquidity of a business? So today we'll just be talking about mostly trade payables. So thank you so much. Please, if you're yet to subscribe to this channel, kindly click on the subscribe button and please subscribe, like and share our videos. Thank you so much for the support. So we'll talk about the meaning of the trade payables. What are trade payables? So trade payables are basically money that a business owes to its suppliers or vendors. So we have examples like if a company is receiving um, electricity supply and has not paid, the company has not yet made payment for that electricity. That payment is maybe the payment is going to be made in arrears, not in advance. So that kind of thing is going to appear as trade payables. It's going to appear on the payable section of the balance sheet. And this trade payables, where does it appear on the balance sheet? It's under the current liabilities. So it's under the liabilities section of the balance sheet, not just in the liability section, but it's in the current liability. And why is that? This is because trade payables, they are expected to be paid within a short period of time, which is usually 12 calendar months. So if you're having some kind of liabilities that is more than a year, that will not classify as a trade payable. Trade payables are usually what the company owes to suppliers or vendors for a very short period of time, which is 12 months. So if that's clear, so let's talk about the trade payables. We've tried to understand what the trade payables means. We said it's money that is owed by the that is owed to the suppliers or vendors. Money owed by the business to suppliers or vendors. So we've talked about where is those trade payables, where is it found on the balance sheet, and we said it is found on the current liabilities section of the balance sheet. It's a current liability. So now let's talk about how does this trade payable, how does it impact the liquidity of a big company? Does it mean that if a company has a high rate of trade payables, does it mean that the company is heading towards bankruptcy? So let's talk about that. You remember how we talked about the trade receivables on our last video? We talked about how it impacts on liquidity. You should please look up to see that video. It's really important. The trade payables does not the increase in when the trade payables is high, it doesn't affect the liquidity negatively in the short run. When I mean in the short run, like in a short period of 12 months, if your company's trade payables is getting higher, it doesn't negatively impact the liquidity instantly, that is in the short run. It only impacts the um, liquidity of the company on the long run because it stresses the liquidity of the company. It shows because when the company is owing too much money to its suppliers, it tells on the financial integrity of the company. It tells on how like they are not paying their debts on time. So that affects the business. So because when that happens for over a long period of time, you will see that the business has most of its cash. The cash is still in the company, is still in the business rather, but you know that that cash is not meant for the business, and over time it's going to be returned to its suppliers. So when this takes more than 12 months, you see that that high trade payable tends to impact on the business, because eventually the company is going to make payment of these trade payables, and that will lead to a very high rate of cash outflow from the business. And when there's a lot of cash outflow from the business at and it's happening at a certain period of time, it can lead to illiquidity, and it can make the business go bankrupt. Initially the company was enjoying, all the money was just there in the business, the cash was there in the business, was just staying idle, but that cash was not meant for the business, and over the long run the cash had to leave the business, and that had an impact on the liquidity of the business. So this high trade payables doesn't impact the liquidity initially, but over time it does stresses on the liquidity of the business. It leads to a high cash flow, and that impacts the liquidity of a business. I hope you understand the difference between the trade receivables. Meanwhile, the trade receivables affects the liquidity instantly, because there is low cash inflow. There's low cash inflow. Customers are not paying their debts as at when due. So the company is not getting inflow. So that one impacts it on the short run. Instantly, it impacts it. But for the trade payables, you are owing your suppliers and you are not making those payments on time. So that cash is still in the business and it's just there. So it doesn't impact it immediately. But over a long time, it affects the business. So that's just the difference. Thank you so much guys for watching my videos. I share tips on accounting, tips on finance, and bookkeeping. I keep you abreast with the current financial trends in the country. Thank you so much for watching my videos. I really appreciate you guys for your love and support. For now, sadly to say, for now it's bye. Thank you. Bye. Yeah.